Welcome to Financial Habits. In this video we are going to talk about how to invest and win money when the market is crashing. So before starting this video, like this video and subscribe to Financial Habits for future updates. The simplest and most straightforward way to benefit from a stock market collapse is to do one of life's most difficult tasks: nothing. Stand there, don't just do something, is, in my view, the right technique. This, of course, means that your asset allocation strategy is suitable for your time frame and risk tolerance. It also means that your assets have declined as a result of the market's decline, rather than because you invested in a dot-com business with no sales. That's exactly what I've done. My asset allocation strategy hasn't changed. I've been investing on a daily basis, just as I had before. I've only ever sold one mutual fund, and it was for tax purposes. To preserve my asset allocation, the proceeds will be reinvested in the market. However, if you want to speed the road to financial independence, during a bear market you can use the following strategies. Number 1. Now is the time to max out your 401k. One takeaway from the bear market of 2007 to 2009 is that if you buy index funds in a 401k on a regular basis, you'll be effective when the market recovers. Those who used this tactic had no idea whether the bear would end in 2007, 2008, or in March of 2009, as it did. But, if you haven't already, it's time to increase your 401k contribution and move forward this year. Do you think that's crazy? You don't think you can afford it? I recall a relative telling me that their 401k had been cut in half by the time the last bear market ended, but that all of the shares bought along the way had turned out to be insanely lucrative once the market had reversed and risen higher. Those who stuck it out, like my relative, made a lot of money, the cheaper shares purchased during the recession by 2015. When you factor in company matching, and all of the money deposited into the account as a result, as well as shares acquired prior to the market's peak in 2006-2007, you can see how much a portfolio can expand. Now, it's probably not a good idea to go all in at once, but rather to spend small amounts on a regular basis. You won't even miss the money after a while, because your portfolio will be rising at an exponential rate behind the scenes. Number 2. Look for dividend-paying stocks. A dividend is paid out of a company's net profits, while the stock price is determined by buying and selling on the stock market. If the stock price falls but the business remains solid, profitable, and pays a dividend, it becomes a great choice for those looking for extra income. One of the cornerstones of value investing is finding dividend-paying stocks. Just make sure you know what you're looking for, and don't just pick a dividend-paying stock at random. There is a method to the madness in this situation. Number 3. Identify sectors that have a tendency to rise in price during a bear market. It's useful to look back at previous bear markets to see which stocks, properties or sectors still rose, or at least kept their own, when the economy was falling apart all around them. Many financial websites publish sector efficiencies for various time periods, making it easy to see which sectors are currently outperforming others. Start allocating some of your investment dollars to certain markets, as when an industry performs well, it usually does so for a long time. Bear markets can be triggered by a variety of factors, so this approach can help investors plan their investments accordingly. Number 4. ETFs can be used to diversify and shuffle sectors. It's no secret that different industries perform well through economic ups and downs. When the economy is doing well, a company that sells big-ticket items like technology, vehicles, green home renovation, healthcare advancement, and other similar large transactions, for example, tends to do well. As a result, their stock prices have risen. These are described as cyclical stocks. When the economy seems to be heading for a downturn, it's a good idea to switch to stocks that are related to basic human needs, such as food, grocery stores in the consumer staples sector, blue-chip energy stocks, and even clothes and real estate, depending on where they're based and who the target customer is. Using exchange-traded funds, ETFs, with your stocks, and implement an industry rotation strategy. Number 5. Bonds can be purchased. Bond purchases are an excellent way to counteract a bear market. Keep in mind that a contracting market usually happens during tough economic times. It frequently reveals which companies have an excessive amount of corporate debt to manage and which corporations are typically doing a decent job of managing their debt. However, how do you know where to begin? To begin, it's important to understand who issues bonds. The federal government issues treasury bonds. Cities, states, and regional governments all sell municipal bonds. Individual corporations issue corporate bonds. Government-sponsored companies such as Freddie Mac and Fannie Mae issue agency bonds. Second, there are several options for purchasing bonds. The United States Treasury, the Treasury Direct website allows you to purchase bonds directly from the government. Bond ETFs. You can purchase bond ETFs from your current broker to get a wider range of bonds at a lower rate. The Vanguard Total Bond Market ETF, BND, and the Schwab US Bond Aggregate ETF are two that we want, SCHZ. Your broker, some brokers, such as E-Trade and TD Ameritrade, allow you to buy bonds directly, but the process is a little more involved. I'd only suggest this if you already have a brokerage account with one of the bond-selling companies, and even then, I'd check out the Treasury Direct website first. Finally, when purchasing bonds, there are a few things to keep in mind. Credit ratings. A bond rating is a commonly used indicator of a company's creditworthiness. A third-party bond rating company, such as Standard & Poor's or Moody's, assigns the rating, and AAA is the highest possible rating available. Bond length. The duration of a bond indicates how resilient it would be to rate shifts in the economy. Since the value of a bond declines as rates rise, a longer term will indicate more ups and downs when rates adjust. When buying bonds, make sure you're not paying, or at least mindful of, any extra fees paid by your broker. As I previously said, you may be better off purchasing them directly from the government. Although this isn't meant to be a comprehensive guide to bonds, it should provide you with enough details to get started, buying one of the better hedges against bear markets. However, you can learn more about bonds by reading our bond guide. Number 6. Shorting underperforming stocks. This is only for experienced investors, and novices can avoid it. Short selling is when you borrow money to buy stock and then sell it right away. The aim is to repurchase them at a cheaper cost, sell the shares to the investor, and benefit on the difference. Shorting a stock is extremely dangerous, because it's simply gambling. Even the most detailed investment research cannot guarantee that a stock will lose value, but in a bear market, it will definitely help. Number 7. Buy dividend-paying stocks on margin. Buying stock on margin is another advanced strategy. The opportunity to use margin is probably something you've seen in your online brokerage account. Margin is essentially a loan from your brokerage to purchase stock up to a certain amount. Why would you do anything like this? You may be able to buy a bunch of shares on margin, without using your own money, and hope they appreciate in value if you can find stocks that are undervalued but still pay a dividend. Plus, there's the added benefit of dividends. Best case scenario, the stocks recover, and you can sell them to repay your margin balance while profiting. Worst case scenario, the stocks begin to fall in value, and you hope that dividends will help you recoup some of your investment. Buying on margin is risky, so you must be well versed in the process. In a bear market, though, if done correctly, you can be extremely profitable. Other factors to think about in a bear market. It's a fool's game and try to time the stock market. Before the market downturn this year, a friend of mine sold all of his equity assets, a 7-figure portfolio. Friends congratulated him on such a wise decision at a party at his house the other day. So I inquired as to whether he intended to return to the market at this time. He declined. Then I inquired as to when he planned to return to the market. He had no idea. But I reminded everyone that his decision to sell would only be successful if he also bought at the right time. And you must be right over and over again as an investor's lifespan progresses. Best wishes. What do you think about this video? Do let us know down in the comment section below. If you enjoyed this video and want to hear from us again, be sure to hit that subscribe button before you go.